Hi everyone, and welcome to your one-stop shop for understanding income-generating ETFs. Today, we're diving deep into three popular options: QYLD, XYLD, and DIVO. These guys all go by fancy names, but they share a common strategy: covered calls. Ever heard of them? Covered calls are a way to generate income from your investments, but there's a catch: they can also limit potential gains. So, if you're looking for a juicy income stream, these ETFs might be tempting. But are they the right choice for you? We'll break down exactly how QYLD, XYLD, and DIVO work, compare them side by side, and even explore some alternatives. By the end of this video, you'll be a covered call master, ready to decide if these income machines deserve a spot in your portfolio. Stick around, it's gonna be an informative ride. How do QYLD, XYLD, or DIVO ETFs compare to other income-generating investment options like bonds? Here's a breakdown of how QYLD, XYLD, DIVO ETFs compare to bonds as income-generating options. QYLD, XYLD, and DIVO, covered call ETFs. High yield: these ETFs offer much higher yields, often above 10%, compared to most bonds, which can be attractive for income seekers. Covered call strategy: they generate income by selling, writing, covered calls on their underlying holdings, stocks in the NASDAQ 100 for QYLD and XYLD, and a basket of high-yielding stocks for DIVO. This means they forego potential capital appreciation if the stock price goes above the strike price of the call option. Lower volatility: covered call ETFs tend to be less volatile than the underlying stocks because they capture option premiums that act as a buffer during downturns. Tax implications: distributions from covered call ETFs can be a mix of dividends and capital gains, with tax implications depending on the specific breakdown. Some payouts may be classified as return of capital, reducing your cost basis, potentially delaying taxes. Bonds. Lower yield: bonds, especially government bonds, typically offer lower yields, often below 5%, compared to covered call ETFs. Capital appreciation potential: bonds can appreciate in value if interest rates fall. They also offer a return of your principal amount at maturity if held to term. Lower volatility: generally, bonds are less volatile than stocks, making them a good option for income investors seeking stability. Predictable income: bonds typically pay regular interest payments, offering a more predictable income stream. Tax implications: bond interest payments are generally taxed as ordinary income. Choosing between them. Income needs: if your primary goal is high current income, covered call ETFs may be appealing due to their higher yields. Investment horizon: covered call ETFs may not be ideal for long-term growth as they cap potential upside. Bonds can be a better option for long-term investors seeking capital appreciation alongside income. Risk tolerance: covered call ETFs offer lower volatility than the underlying stocks, but still have some stock market risk. Bonds are generally considered a safer investment. Tax situation: consider the potential tax implications of each option. Bonds offer predictable ordinary income taxation, while covered call ETFs may have a mix of dividend and capital gains treatment. Here are some additional factors to consider. QYLD versus XYLD versus DIVO. These covered call ETFs have different underlying holdings, and may have slightly different risk-return profiles. Alternative income options: explore other dividend-paying stocks, high-yield corporate bond funds, or REITs, real estate investment trusts, that may offer a good balance of yield and growth potential. Are there any tax considerations specific to covered call ETFs? Yes, there are some specific tax considerations for covered call ETFs compared to traditional holdings like bonds. Here's a breakdown of the key points. Distribution components. Covered call ETFs generate income by selling, writing, covered calls on their underlying holdings. The income you receive is a combination of two things. Option premium. This is the money received up front when you sell the call option. It's considered a capital gain. Dividends. The ETF may also receive dividends from the underlying stocks it holds. These are taxed as ordinary income. Tax treatment. Option premiums. The premiums received from selling covered calls are generally taxed as short-term capital gains if the underlying stock is held for less than 1 year, or long-term capital gains if held for more than 1 year. The specific tax rate depends on your overall income tax bracket. Mixed straddle election. Covered call ETFs typically elect to use a mixed straddle rule for tax purposes. This avoids some complexities, but might affect how certain gains or losses are classified. Consult a tax professional for details. Return of capital, ROC. In some cases, part of the distribution from a covered call ETF might be classified as a return of capital, ROC. This reduces your cost basis in the ETF shares, potentially delaying capital gains taxes until you sell the shares. However, it also reduces the amount of future distributions that qualify for favorable capital gains treatment. Impact on taxes. Potentially lower tax bill. Compared to receiving all dividends, taxed as ordinary income, covered call ETFs can offer some tax advantages. The option premiums can be taxed at lower capital gains rates, potentially reducing your overall tax bill. Uncertainty and complexity. The tax treatment of covered call ETF distributions can be more complex than with traditional holdings. The mix of capital gains and potentially ROC can make tax calculations less straightforward. Recommendations. Consult a tax professional. Due to the complexities involved, it's highly recommended to consult a tax professional for personalized advice on how covered call ETF distributions will impact your specific tax situation. Consider tax efficiency. When choosing a covered call ETF, consider its historical distribution breakdown, dividends versus capital gains, to get a sense of the potential tax implications. Track your basis. Keep good records of your cost basis in the ETF shares to accurately calculate capital gains or losses when you sell. What level of investment experience is recommended for someone considering QYLD, XYLD, or DIVO ETFs? The recommended investment experience level for someone considering QYLD, XYLD, or DIVO ETFs depends on several factors. Understanding of covered calls. Basic. A basic understanding of covered calls is essential. You should know that covered calls generate income by selling options contracts, which limit potential upside but provide a buffer against downside. Intermediate. Ideally, you should understand the mechanics of covered calls, including strike prices, expirations, and how they affect potential returns. Knowledge of option strategies. Basic. While a deep dive into option strategies isn't necessary, some basic knowledge of how options can impact price movements and portfolio risk is helpful. Intermediate. Understanding concepts like delta and theta can provide more insight into how covered call ETFs behave in different market conditions. Tax implications. Basic. Be aware that covered call ETF distributions can be a mix of capital gains and dividends, with varying tax implications. Intermediate. Understanding the potential tax benefits and complexities of covered call ETFs is important. Consulting a tax professional is recommended. Risk tolerance. Moderate. Covered call ETFs offer some protection against downside volatility, but still carry market risk. They may not be suitable for very risk-averse investors. Moderate high. investors comfortable with some market risk and potential for missed upside can potentially benefit from covered call ETFs. Investment goals. Income generation. If your primary goal is high current income, covered call ETFs can be a good option, but understand the trade-offs. Long-term growth. These ETFs may not be ideal for long-term capital appreciation due to capped upside. Experience breakdown. Beginner investor. Limited investment experience might make covered call ETFs a less suitable choice due to the option strategy complexities and tax considerations. Consider simpler income-generating options like bonds or dividend-paying stocks. Intermediate investor. With a basic understanding of options, risk tolerance for moderate market fluctuations, and a focus on current income, covered call ETFs could be a viable option. Consulting a financial advisor can be beneficial. Advanced investor. Investors with a strong understanding of option strategies, tax implications, and a focus on income generation can potentially leverage covered call ETFs effectively within their portfolio. How does the underlying index of the Global X NASDAQ 100 Covered Call ETF, XYLD, differ from QYLD? There actually isn't a fundamental difference between the underlying indexes of QYLD, Global X NASDAQ 100 Covered Call ETF, and XYLD, also Global X NASDAQ 100 Covered Call ETF. Both ETFs aim to track the performance of the NASDAQ 100 index through a covered call strategy. Here's why there might be some confusion. Same underlying index. The core holdings of both QYLD and XYLD are based on the NASDAQ 100 index. This index tracks the 100 largest non-financial companies listed on the NASDAQ stock exchange. Synthetic replication versus direct investment. There might be a misconception that XYLD tracks a different index due to some sources mentioning synthetic replication. This refers to the way the ETF achieves its objective. While QYLD might directly invest in the underlying stocks of the NASDAQ 100, XYLD might use financial instruments to mimic the performance of the index without directly holding all the stocks. This doesn't change the fundamental target, the NASDAQ 100. Potential reasons for using synthetic replication. There are a few reasons why XYLD might use synthetic replication instead of direct investment. Cost efficiency. Synthetic replication can be a more cost-effective way to track the index, especially for large and liquid indexes like the NASDAQ 100. Tax optimization. The specific implementation of synthetic replication might offer some tax advantages, but this can be complex and depends on the specific strategy used. Key takeaway. Both QYLD and XYLD essentially offer exposure to the NASDAQ 100 index through a covered call strategy. The minor difference lies in the potential method used to achieve that exposure, direct investment versus synthetic replication. This difference is unlikely to have a significant impact on the overall performance of the ETF for investors. What is the specific methodology used by the Amplify BlackSwan Enhanced Dividend Income Fund, DIVO, for selecting its underlying stocks and writing calls? While Amplify BlackSwan Enhanced Dividend Income Fund, DIVO, publishes details about its general investment strategy, the specific methodology for selecting underlying stocks and writing calls is not publicly available. This information is often considered proprietary by the fund manager. Here's what we do know about DIVO's methodology. Focus on high-quality dividend growers. DIVO targets high-quality large-cap companies with a history of paying and growing their dividends. Active management. Unlike QYLD and XYLD, which track indexes, DIVO is actively managed. The fund manager, CWP, selects specific stocks based on their criteria. Tactical covered calls. DIVO uses a covered call strategy on a portion of its holdings to generate income. However, the details of how they select which stocks to write calls on and the specific call option parameters, strike price, expiration date, are not publicly disclosed. Consult a financial advisor. For a more comprehensive understanding of DIVO's investment strategy, it's recommended to consult with a financial advisor. They can help you analyze the fund's holdings, historical performance, and risks associated with its active management and covered call strategy. Alright everyone, that's all the time we have for today. So, to recap, QYLD and XYLD offer a high yield through covered calls on the NASDAQ 100, but you give up some potential upside. DIVO uses covered calls on a basket of high dividend stocks for a more active approach. Remember, covered call ETFs come with tax implications and may not be suitable for all investors. Before you jump in, consider your investment goals, risk tolerance, and time horizon. There are other income options out there, so do your research and consult a financial advisor if needed. Thanks for watching. Don't forget to like this video and subscribe for more in-depth investment explorations. Hit the notification bell so you never miss an upload. I'll see you on the next one.